There's a $1 billion free money glitch sitting in plain sight right now. Everyone can see it. Nobody can touch it. And the reason why should absolutely terrify you. Silver costs $75 in New York. That exact same silver costs $130 in Shanghai. Same metal, same purity, same day, $55 difference per ounce. Ship it across the ocean, pocket the difference. That's $1 million in pure profit on a single shipping container. 3-week turnaround. Every trading algorithm on Wall Street sees this gap. Every arbitrage desk at every major bank sees it. Every hedge fund with a commodities team sees it. And nobody is closing it. Not because they don't want to, because they physically cannot. And that impossibility is about to break the entire global silver market. Welcome to the Independent Financial Historian. If you're new here, I expose market dislocations that the financial media refuses to touch. Subscribe right now because what I'm about to show you isn't speculation. This is cargo manifests, vault inventories, and refinery data that proves the largest wealth transfer in precious metals history is happening right now while you're watching this video. Here's how arbitrage is supposed to work in a functioning market. A trader sees silver at $75 in New York. They see it at $130 in Shanghai. They buy in New York, ship it to Shanghai, sell at $130, pocket $55 per ounce minus shipping costs. Shipping and insurance for silver from New York to Shanghai runs about $2 to $3 per ounce. Converting a COMEX good delivery bar into Shanghai kilogram bars costs another $1.50 in refining fees. Call it $5 all in for logistics. That leaves $50 per ounce profit on a container holding 25,000 ounces. That's $1.2 million in pure arbitrage profit on a 3-week turnaround. Every algorithmic trading desk on the planet is programmed to execute trades exactly like this automatically. The computers see it, the humans see it, so why is the gap still there? Because that $75 COMEX price assumes you can actually buy physical silver at $75. It assumes COMEX has metal in the vault. It assumes you can take delivery. It assumes refineries can convert your bars on reasonable timelines. It assumes you can export the refined silver from the United States without regulatory delays. It assumes Chinese customs will clear your shipment without complications. Remove any one of those assumptions and the arbitrage explodes. Every single one of those assumptions is now completely broken. Here's what caused this catastrophic breakdown. COMEX registered silver inventory, that's metal actually available for delivery against futures contracts, stood at 356 million ounces in January 2021. 5 years of a functioning market with normal delivery operations. As of late January 2026, COMEX registered inventory is 113 million ounces. Read those numbers again. 356 million down to 113 million. That's a 68% collapse in deliverable inventory in just 5 years, but it gets so much worse. Reports from early January 2026 show that in a single 7-day period, 33 million ounces of silver walked out of COMEX vaults, not traded on paper, physically removed, loaded on trucks, gone. In 1 week, more silver left COMEX than some entire national reserves hold. Let that sink in for a second. COMEX currently has 500 million ounces of open interest in silver futures, 500 million ounces of contracts that theoretically promise delivery, 113 million ounces of metal actually sitting in the vault available to deliver. That's a ratio of 4.4 to 1. For every 1 ounce of real silver in the COMEX system, 4.4 paper claims exist against it. If just 23% of contract holders demand delivery, the vault is completely empty. Not stressed, not tight, empty. Now connect the dots. On January 1st, 2026, China reclassified silver as a strategic export-controlled commodity. Not a recommendation, not a tariff, a hard control. Silver is now in the same category as rare earth elements and military technology. Under the new rules, only 44 state-approved companies can export silver from China, not 400, not 40,000 independent traders, 44 government-approved entities. To qualify, a company must produce at least 80 tons of silver annually and maintain substantial financial reserves. That effectively limits participation to state-owned or state-connected enterprises. Here's what that means in practice. China refines 60 to 70% of the world's silver. Most of that refining processes imported silver concentrate from mines in Mexico, Peru, and Australia. China imports the raw material, refines it into London good delivery bars or Shanghai Gold Exchange kilos, then historically re-exported a portion back to global markets. That loop is now severed. China still imports the concentrate. China still refines it. But now that refined silver stays in China unless the government explicitly approves its export through one of the 44 licensed entities. And those approvals are going to Chinese solar manufacturers, Chinese EV battery makers, and Chinese electronics companies. Not to London dealers trying to cover short positions, not to New York arbitrage desks trying to close the COMEX Shanghai gap. Draw your own conclusions about whether that timing, January 1st, exactly when COMEX inventories hit crisis levels, was coincidental. Imagine you're an arbitrage trader. You finally sourced 10,000 ounces of physical silver in New York at $80 per ounce. You paid a $5 premium over COMEX because nobody's actually selling at $75 anymore. That's just the futures quote on paper. Fine. You're still looking at a $40 arbitrage profit in Shanghai. Now you need to convert your COMEX good delivery bars into Shanghai Gold Exchange kilogram bars. A COMEX bar weighs 1,000 troy ounces, roughly 31 kilograms. A Shanghai kilobar is 32.15 troy ounces. You cannot just ship COMEX bars to Shanghai and sell them. The Shanghai Gold Exchange does not accept them for settlement. You must recast them into kilos. There are maybe 6 refineries globally with the capacity, accreditation, and throughput to do this conversion at scale. Perth Mint in Australia, Heraeus in Germany, Pamp Suisse, a handful of Chinese and Indian refineries. In normal times, turnaround is 1 to 2 weeks. We are not in normal times. Refineries are currently quoting 4 to 8 week delivery windows. Why? Because every arbitrage desk, every industrial user, every sovereign wealth fund trying to source physical silver is hitting the same bottleneck. Refining capacity is finite. You cannot just spin up a new LBMA accredited refinery in 90 days. So you wait 8 weeks. While you wait, silver prices move. Maybe COMEX drops to 70 because more paper selling hits the market. Maybe Shanghai spikes to 140 because Chinese manufacturers panic buy. Your $40 arbitrage profit just turned into a $20 loss, and you haven't even shipped the metal yet. This is why the gap persists. The mechanics of closing it are completely broken. But here's the part that kept me awake last night researching this. There's an economic principle from the 1500s called Gresham's Law. Sir Thomas Gresham, advisor to Queen Elizabeth I, observed that when 2 forms of money circulate simultaneously, one with real intrinsic value and one debased or backed by questionable promises, the valuable money disappears from circulation while the questionable money remains. Bad money drives out good. When Henry VIII debased English coinage by reducing the silver content while maintaining the face value, merchants immediately started hoarding the old full-weight coins and spending the debased coins. Rational actors retain assets with real value and pass along substitutes with uncertain value. We're watching this play out in real time in the silver market right now. On one side, you have physical silver, metal you can hold, metal sitting in an allocated vault with your name on specific serialized bars, metal that cannot be created through financial engineering, genuinely scarce. On the other side, you have paper silver, COMEX futures contracts that promise delivery but settle in cash 98% of the time, silver ETFs with force majeure clauses that let them suspend physical redemptions during extraordinary market conditions, a term the prospectus does not define. Unallocated silver accounts where your claimed ounces are actually shared fractionally across multiple account holders. For decades, these 2 forms traded at the same price because they were functionally equivalent. If you held paper silver and wanted physical, you converted it at par. No problem. That equivalence is now breaking down. The $75 COMEX price reflects the value of paper. Contracts backed by a system where 4.4 claims exist for every ounce of physical metal. The $130 Shanghai price reflects the value of actual physical silver you can touch, store, and use without counterparty risk. Gresham's Law predicts exactly what we're seeing. Holders of physical silver refuse to sell it at paper prices. They hoard it. They wait for physical prices to reflect true scarcity. Meanwhile, paper floods the market because holders realize those claims might not convert to metal at the stated price. Bad money is driving out good. Here's the smoking gun that proves this is happening right now. Look at what sophisticated money is doing. The iShares Silver Trust, ticker SLV, is the largest silver ETF in the United States. It holds silver in unallocated form. Your shares represent a claim on a pool of silver, not specific bars. The prospectus contains force majeure language allowing the trust to settle redemptions in cash instead of metal during market disruptions. SLV experienced significant outflows throughout late 2025 and early 2026. Investors are liquidating. At the exact same time, the Sprott Physical Silver Trust, ticker PSLV, has seen record inflows. PSLV holds 100% allocated physical silver. London good delivery bars stored in Royal Canadian Mint vaults with full audit transparency. Every share represents ownership of specific serialized bars. You can redeem for physical metal without force majeure exceptions if you hold enough shares. On January 20th, 2026, Sprott announced they were doubling their at-the-market equity program from $1 billion to $2 billion. That capital raise allows them to purchase approximately 18 million ounces of additional physical silver. 18 million ounces is 16% of remaining COMEX registered inventory. A single trust is preparing to buy 16% of all deliverable COMEX silver. This is not retail panic. This is institutions with billion-dollar research budgets and legal teams that have read every prospectus fine print. They are moving capital from paper vehicles with force majeure clauses to physical vehicles with guaranteed allocated metal. They know what's coming. Now here's what should really break your brain. Technology companies are bypassing exchanges entirely and locking up physical supply at the source. Tesla reportedly purchased 85 million ounces of physical silver in mid-January 2026. Not COMEX futures, not SLV shares, 85 million ounces of physical metal executed through mine contracts, vault acquisitions, and off-market deals assembled over 72 hours. That purchase equals 75% of total COMEX registered inventory. Tesla bought 3/4 of all silver currently available for delivery on COMEX, and they did it without touching public markets. Samsung negotiated an exclusive offtake agreement for 100% of the La Paria silver mine's output for 2 years. They own the mine's production before it even comes out of the ground. That silver will never reach a vault. It will never trade on an exchange. It goes directly from the refinery to Samsung's battery production lines. Apple, according to reports, has run internal scenarios modeling silver supply disruptions. Their worst-case valuation? $573 per ounce. Not because they think silver is worth that as an investment, because the cost of a production line shutdown for lack of silver components exceeds the cost of paying $500 per ounce to secure supply. When an iPhone assembly line runs at $200 million per day in output, paying any price for guaranteed silver supply becomes economically rational. Read those numbers again. Tesla, 85 million ounces removed from the market. Samsung, 2 years of mine output locked exclusively. Apple willing to pay $573 per ounce if necessary. These are not companies speculating on silver prices. These are companies recognizing that the commodity exchange system can no longer guarantee supply, so they are integrating backward, locking up upstream production, and removing silver from tradable markets entirely. They are hoarding the good money. So what happens next? The $28 gap cannot close through normal arbitrage because every mechanism required for arbitrage to function is broken. Mechanism 1. Supply response to price signals. In normal commodity markets, when prices double, miners increase production. Existing mines ramp up. New mines get financed. Marginal deposits become economic. Supply expands and prices moderate. Silver does not work this way. 70% of mined silver is a byproduct of zinc, copper, and lead extraction. Silver supply is constrained by base metal economics, not silver prices. A copper mine facing declining ore grades will reduce output even if silver is at $150 per ounce because the mine economics are driven by copper, not silver. Price signals do not increase silver supply on any timeline that matters. New silver mines require 7 to 10 years from exploration through permitting, financing, construction, and first production. A mine starting production in 2026 reflects exploration decisions made in 2016 when silver was $15 per ounce. Projects responding to 2026 prices will not produce metal until 2033 or later. The market cannot wait 7 years. Mechanism 2, demand destruction. In normal markets, when prices spike, demand collapses. Consumers substitute alternatives or defer purchases. This is not happening with silver. Solar panel manufacturers cannot pause production because silver costs spiked. They have contracts, installation deadlines, government subsidies with expiration dates. They pay the higher silver price and pass costs to customers, or they shut down entirely and destroy shareholder value. They pay. Electric vehicle manufacturers building solid-state batteries with silver-carbon anodes cannot substitute copper or aluminum. The technology requires silver. They either secure silver supply or abandon the entire product line after billions in R&D investment. They pay. AI data centers cannot defer construction because silver got expensive. Power density requirements and thermal management in high-performance computing demand silver. The cost of delaying data center deployment exceeds the cost of expensive silver by orders of magnitude. They pay. This is inelastic demand meeting constrained supply with broken arbitrage mechanisms. The gap does not close, it widens. Here's what I'm watching that should terrify you. COMEX, March 2026. Silver contracts represent over 500 million ounces of open interest. Registered inventory, 113 million ounces. If even 23% of those contracts demand physical delivery instead of cash settlement, COMEX cannot fulfill the obligation. Every COMEX futures contract contains a force majeure clause. The language permits the exchange to suspend physical delivery during extraordinary market conditions and settle contracts in cash at a price determined by the Exchange Settlement Committee. That language is deliberately vague. The exchange defines what constitutes extraordinary conditions. The exchange determines the cash settlement price. If COMEX invokes force majeure on March contracts and forces cash settlement at, say, $85 per ounce while physical metal is trading at $130 in Shanghai, what happens? Every futures trader holding contracts expecting $130 metal gets settled at $85, a $45 per ounce loss imposed by exchange fiat. That's not a market, that's expropriation. The credibility damage to COMEX would be terminal. Every industrial user, every sovereign wealth fund, every institution that relies on futures for hedging would recognize that COMEX can no longer guarantee physical delivery. The migration to physical markets would accelerate overnight. Shanghai becomes the global price discovery center by default because Shanghai still delivers actual metal. I'm not predicting this will happen. I'm telling you the mechanics exist for it to happen and the inventories are at levels where it becomes possible. Possible is enough to move markets. Here's what I'm watching over the next 60 days. 1. COMEX registered inventory. If it drops below 100 million ounces, the math becomes impossible to ignore. We're at 113 million now. One bad week of withdrawals puts us there. 2. Shanghai physical premiums. If the premium over COMEX exceeds $40 per ounce and sustains for more than 2 weeks, it signals that arbitrage has completely failed and the markets have permanently bifurcated. 3. Silver lease rates. These are the cost of borrowing physical silver against dollar deposits. Normal lease rates are below 2% annually. In late 2025, they spiked to 35%. If lease rates exceed 40% and hold for more than 72 hours, it means physical silver is unavailable at any reasonable cost in London and New York. 4. Refinery delivery windows. Currently quoting 4 to 8 weeks. If major refineries extend quotes beyond 12 weeks or stop accepting new orders entirely, the conversion bottleneck has become total gridlock. 5. ETF divergence. Watch the SLV to PSLV premium. SLV is unallocated with force majeure clauses. PSLV is allocated without force majeure protections. If PSLV shares start trading at a 10% or greater premium to net asset value, while SLV trades at a discount, it means institutions are pricing in the probability of SLV force majeure settlement. These are not speculative indicators. These are mechanical measures of system stress. When multiple indicators flash red simultaneously, the system is in failure mode. Markets like this separate survivors from casualties. Not based on who predicted the exact top or bottom, not based on who had perfect information, based on who recognized the structural break and positioned accordingly before the crowd understood what was happening. Physical silver holders recognized months ago that paper and physical were decoupling. They moved capital into allocated metal and removed it from exchange vaults. They're not checking prices every 15 minutes panicking about drawdowns. They're waiting for the inevitable reconciliation between paper and physical. Paper silver holders, traders in COMEX futures, holders of unallocated ETFs are now discovering that their $75 positions do not convert to $130 metal. Some will get force majeure settled at exchange-determined prices. Some will exit at losses. Some will hold and hope the gap closes through mechanisms that no longer function. They are casualties of a system that promised fungibility between paper and physical. And that promise is breaking right now. Someone will survive this. Someone will hold physical metal through the panic and sell it when clarity returns at prices that reflect true scarcity. Someone will recognize that the $28 gap is not an arbitrage opportunity. It's a signal that the commodity market structure is collapsing. That could be you. Or you could be the trader who assumed COMEX delivery would always work, right up until the exchange declared force majeure and settled your position in cash at a 30% discount to physical. One of those outcomes involves understanding what you just watched. The other involves assuming the system still functions the way it did 5 years ago. Choose accordingly. Drop your thoughts in the comments. Are you holding physical or paper? Are you watching the COMEX registered inventory? Have you tried to source physical silver from a dealer recently and faced delivery delays? I want to hear what you're seeing on the ground because the data I'm tracking is macro level. Your direct experience fills in the gaps the vault reports don't show. If you found value in this video, share it with someone who needs to see it, not for algorithm points. Because there are people holding paper silver who don't understand the force majeure clauses in their prospectuses. There are people assuming the $75 COMEX price means they can buy physical at $75, and that assumption is going to cost them everything. Sharing this could be the difference between someone making an informed decision and someone discovering they're a counterparty to a broken contract when it's too late to exit. Subscribe if you're not already. I'm covering the silver decoupling daily until it resolves one way or another, either through COMEX force majeure and a formal market bifurcation, or through Shanghai premiums compressing as supply somehow normalizes. Either way, you'll see it analyzed here first with the vault data and cargo manifests the financial media will not touch. See you tomorrow. We're just getting started.